Hi, good evening, everyone. Welcome back to the channel. So in this video, we're going to go over some news that's a bit, I would say old news at this point, but nonetheless, we want to cover it. So Mike Khouw has been added to the YieldMax team. He's an options expert with years of experience, and he's been added in a strategist role. So we're going to review a couple of appearances he's had. He went on Retire on Dividends. He's been on Max Convexity's channel. So we'll review some of those and go over the move and how it may enhance YieldMax's returns. So first, let's just kind of review his credentials and basically the news release, which basically happened a couple weeks ago. So YieldMax is pleased to announce the appointment of Mike Khouw as YieldMax strategist. This is a role they've never had before. Oops, let me make sure I do this. There we go. Welcome, Richard King. Long time no see. In this role, he will serve as key spokesperson for YieldMax ETFs, bringing his exceptional market insights, strategic expertise, deep experience, and options to the firm. He's got more than 25 years of experience in financial markets. And they said this in the Retire on Dividends interview. He's widely recognized as one of the industry's lead voices in options trading and strategy. So definitely a wealth of knowledge. He was founder and chief strategist of OpenInterest.pro, which is a firm specializing in financial and investment strategy consulting. He's a familiar face on CNBC's Fast Money and Options Action. His background, he used to work for Cantor Fitzgerald, for anybody that doesn't know what that is. One of the cabinet secretaries right now in the Trump administration, Howard Lutnick, he was CEO of that firm. Interesting fact, they were headquartered in the World Trade Center on 9/11. A lot of their employees were lost on 9/11, and Howard Lutnick actually paid the families. He promised up to a certain amount of profits to be allocated to the families, and that was delivered upon within the first 5 years after the attacks. Anyway, side note, sidebar there. But yeah, so Cantor Fitzgerald, he used to be an employee there, and CRT Capital, also former member of Philadelphia Stock Exchange, American Stock Exchange, New York Mercantile Exchange. Previously managed and actively traded ETF, applying AI to optimize returns. That sounds interesting, something we definitely may want to explore. Co-author of The Options Edge, a comprehensive guide to options valuation and strategy. So he's got publications just like Jay. I definitely want to look into that now. The Options Edge. Mike Khouw, let's see here. Here we go. I'm going to pull it up real quick. We'll plug his book for a second. Hey, welcome, Ralph Beans. Thank you. Okay, so let's go over here. We're just gonna just did some Google search. So add it to my Google search repository. Okay, so by Michael C. Khouw and his partner Mark Gutner, The Options Edge. So this seems like it's a very interesting read. Let's we get a Google preview here. Let's see here. I'm just going to skim through this real quick. What's this say? Options provide a way of assessing and managing risk. True. Definitely a lot to read here. Let's see. What did he say here? Talks about baseball, thestreet.com, Players Club. Interesting. Well, that's the Google preview, but it's called The Options Edge. That's a publication that he's got. Okay. So with that, let's switch over really quick. I'm going to react a little bit to Rod's video. And so Rod had Jay and Mike on weeks ago. So let's see how this works. I don't think I've ever done a share of a YouTube video on this platform yet. How's the sound?
Time I entered the business, actually, and it was kind of a dark corner, actually, of the market when I was first involved in it.
So where they are, he just introduced him, and they're talking about basically his background and stuff, and he's telling some anecdotal stories and things like that right now.
Actually, my earliest job as an options market maker, making markets in the oil service index options, which was a kettled option that traded on the Philadelphia Stock Exchange. You know, when you wanted some sort of unique market exposure back at that time, that was pretty much what you got. You would have something.
Speeding it up a little bit.
Something like an exchange traded, cash settled, and these things were pretty clunky. Now, of course, we're seeing rapid innovation.
So early on in the interview, he talked about how he was basically he entered as a floor trader when they still did like paper trades and stuff with actual paper.
Rapid democratization, and we're seeing huge, basically, adoption of options inside the ETF. And this is really new. If you take a look at the amount of assets that are managed, and then you compare that.
So remember, like I was saying, when I went to New York and I last talked to Jay, the market is really evolving with all these new products. You've got ETFs, you've got high yield dividends, you've got so many products now. And it's really an interesting time to be an investor, really interesting time to be alive, certainly. The market just keeps on finding solutions to what investors want, and it's really exciting.
To the growth in the options industry generally that we have seen since, call it 2000. It's exponential growth in the options business, and yet it's still a relatively small corner.
And it's going to continue to be exponential growth because with YouTube and all of that, I mean, people like me, we show our trades. There's a lot of people on here covering options. People are discovering how much can be made in options, and a lot more people are getting into it. I know with YouTube, it's made options knowledge accessible to a lot more people, whereas probably in the 80s or in the 90s, even into the early 2000s, there was so many people that didn't even know like what an option was.
Of ETFs. I think that speaks to the growth opportunity. It just gives more people access to it. And frankly, because options expire, you want somebody like Jay and the team. In many cases, you want these people.
Options expire? What? I'm never trading an option again. How dare they? Kidding.
Managing. It's actually one of the reasons he probably needs to spend as much time as he does in front of the screens. And I don't mean TV screens. I'm talking about the trading screen. So,
so Rod asked him early on, he said, with you coming on board, does that mean Jay's going to take more of a backseat? Are we going to see less of him? That's a good question. That's actually a question I had myself. But I think that Jay is a huge asset to them. He's great on TV. He's great in interviews and all that. I hope he keeps on being as much of a face as he's been, but he is saying he's going to spend more time like on the back end with the traders and all. So we'll see.
I just think it's a natural thing. If I have any regrets, it's that I didn't get on the bandwagon sooner, frankly.
Okay, I appreciate that. No, and to follow up on that, again, I mentioned this earlier, right? So you brought up Misty on, live TV, right? We never even, at least I haven't heard YieldMax or, any other funds mentioned. What is the sentiment on CNBC or?
We're going to skip a few chapters here. We're going to go to LevMax because I've been wanting to cover LevMax. So let's see what he has to say about that. This LevMax stuff came up in New York. It's going to be very interesting. So we're going to skip to that. But before we do that, we have this important message for you that we'll skip. I know we want to help out Rod's ad revenue though.
Day is coming for every American with money in the markets, and it'll be here sooner than you think.
So this one we watched 5 seconds of it, so there we go. Oh, so this question, this MJ Bow Hunter, I remember hearing about 3x up, 1 down group of funds, or did I just have a dream? No, that's LevMax.
One here that we're talking about.
Did you see his body language there for a second? He was like, "Ooh," he's like, "We're getting into this." That's what the body language looked like.
3 up and 1 down was under a brand LevMax, right, which was kind of adjacent to YieldMax. It was kind of a cap, right? It was like a stock repair structure where you're long is synthetic, then long 2 calls, short 3 calls above, right? Like that kind of a deal. So it's still capped X up to this.
I may have to slow this down because it's a little bit over my head. Jay explained this to me in New York. What he just said was exactly what he said to me that day.
So not too much more we can really talk about that. There is a prospectus out there on that. And then Defiance did.
There's an active prospectus, so I guess I can't say too much.
File, but it wasn't a single stock, right? It was a basket, right? And when you start to do the basket, the 2x, 3x thing has to do more with performance on down days and what's known as kind of a VAR calculation, value at risk work. I think it's probably
basically, and you can watch my interview with the other Mike Venuto. He described that for a stock, it's good for like a short-term play for like getting in and getting out, basically.
At this point, way too early to even comment about anything there on what's been filed. So let's let those run through their normal process, and maybe more to come on those things down the road. Okay. So not a great answer. Apologize, but I can't really say about it unless you want to go read the filings, which I know some people like to do, especially Max Convexity likes to read.
Yeah, you read it last night. I saw.
By the way, how are you?
Speaking of someone else, about.
I think I missed this whole stream. So Mr. Kwan, who I also met in New York, he said, with outside eyes, what's one thing you're going to focus on first? What was one thing you'd like to see change, adjusted? Welcome to the community.
Sort of Kwan, I better ask his question. Question for Mike, coming to YieldMax with outside eyes, what's one thing you're going to focus on first and one thing you would like to see changed? And welcome.
Well, I think it's a little premature for me to start talking about this. This being, I think, my first official day.
No, you should get right into everything. First day on the job, boom, get right into everything.
That would be quite the role for me to come in and say, all right, here's what I'd like to change when you have an enterprise that has been as successful as these guys have been doing what they're doing. I think it's funny because when this first hit, I saw a couple posts coming back to me that
there's a chapter about protective puts. Definitely want to play that. So to be clear, so this had Jay and Mike on here. What I want to do real quick, though, I want to segue. I want to look at the prospectus for LevMax. I kept getting it mixed up. Okay, here we go from sec.gov. We're gonna skip over to this tab real quick. Okay, let's see here. And just for fun, just to add to my Google searches for people that like to, we'll do a fun one. We'll just type in levitation. How about that? There we go. Let's type in a fun. Oh, it must be some kind of a concert. Cool. All right. Well, that's just my haters like to really scour through my Google searches and sometimes even make up their own versions of my Google searches. Okay, so here's what we have for LevMax. Okay, just want to make sure we were sharing here. All right, so they've got, let's see, they've got an Amazon fund, Bitcoin fund, Berkshire, Coinbase, Robinhood, Microsoft, MSTR, NVIDIA, Palantir, Reddit, SMCI. Oh, my favorite stock ever, SMCI, and Tesla. So we have prospectuses for LevMax for all of these funds. And so they can't do much, but it's basically a 3-by-1. Let's see what we've got here. Investment objective. Let's just read the investment objective real quick. Generally, on a calendar month basis, each performance period described in greater detail below. LevMax, the ETF, seeks to provide investors with returns that generate approximately 3 times any positive performance of the underlying share price over the course of a performance period, subject to a predetermined upside return cap. So the cap is basically the price that you pay for this to happen, the way they described it to me, while approximately matching any negative performance of the underlying security on a 1-to-1 basis over the course of any such period. So that's how LevMax is supposed to work, folks. It's supposed to be 3 for 1, 3 times the upside, only 1 times the downside. So common complaint, which I think they're addressing, is that YieldMax products tend to be capped at the upside and then unlimited downside. So now we've got basically 1x downside, 3x to the upside. So I think that's awesome. That's like a really good solution on their part. And that's one of the things I like about them is they always are coming up with solutions. The fund is actively managed, blah, 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 seeks to provide returns that generate approximately 3 times. Yeah, same deal. So does everybody understand that 3 times any positive performance over the course of a performance period? I believe that period was supposed to be 30 days, but we'll confirm that. Here's some definitions here. Each performance period span is 1 calendar month, usually starting on the first trading day of the month, usually ending on the last trading day. So, for example, if the trading day, so let's take September, for example, which this time, let's be positive, we're going to buck the trend. This September is going to be amazing, right? This isn't going to be our typical down September. But September 1st, in my opinion, this is like the perfect start to a month. When the first falls on a Monday, September 1st, Monday, September 1st, which happens to be Labor Day, is not a trading day. So in the case of this, you would think, okay, the 1st to the 30th, there's 30 days in September. No, September 2nd is the next market trading day after Friday. And then September 30th is the last trading day. So that's how this would work. It would not always be a perfect calendar month. They specify first trading day of the month and usually ending on last trading day of the month. Keyword usually. Rolling option strategies. At the end of each performance period, the fund will unwind its existing options positions and establish a new option structure for the subsequent period. For example, on the last trading day of February, my favorite month, the fund may establish a new structure for March, and on the last trading day of March, it may establish a structure for April. Intramonth flexibility. The advisor retains the discretion to adjust the fund's option structure prior to the expiration of a performance period if market conditions, liquidity considerations, or regulatory requirements necessitate such action. The advisor may also do so to seek to optimize the fund's performance and or manage risks dynamically. That was a mouthful of legal gobbledygook there. But let's try to summarize that. The advisor retains the discretion to adjust the fund's option structure prior to expiration of a performance period. So the advisor can adjust the fund's option structure if market conditions, liquidity considerations, and regulatory requirements necessitate such action. They can also do so to seek to optimize the fund's performance. So that's awesome. So I would bet there's going to be a higher expense ratio here, folks. Not to be cynical, but they're doing more work for you. So the expense ratio is, I would bet, going to be higher. Thank you all, folks, for all the likes. By the way, I haven't even solicited likes. We've got like basically 1 like for everybody on here. So thank you all. I'm deeply honored from the bottom of my heart. Now let's get back to, we want to look at protective puts. I'm very interested in the concept of protective puts for any kind of product like this. So let's see. Let's go back to the Rod's live stream here. All right, so Shab, let me make sure our goal is to limit black screens on this live stream. All right, so we'll go for 20 minutes, but let's cover the rest of this and then protective puts.
Suggested that, there are things that certain investors think that they want, and they think that these are objectives, and I'm not sure that I entirely agree. I'll give you an example. I saw a number of messages, do something about, quote, NAV erosion, unquote. And
NAV erosion, who cares about that? I mean, that's not like the most commonly requested, like, the most commonly logged concern about these products, is it? Or is it not?
As soon as I saw that, I thought, okay, I do need to do something, but it's probably not what you think it is. What I need to do is have a conversation with anybody who uses that term as a pejorative.
What concerns me is that everybody talks about NAV erosion, but no one talks about beach erosion. Where's all the environmentalists out there? What about beach erosion? That's important too. It's not all about money, folks, after all.
Rather than just taking a look at what I was talking about earlier, which is the total return, right? And I was on an earlier call today. We were talking about this exact same issue, and I said, for most investors, we view returns of our investment to us as a risk reduction. In other words, if I loan you money for a year and you pay me a little bit every day, that's less risky than if I wait the whole year to get it back. And I care about the return of my capital, and I care about the return on my capital. Those are the
interesting characterization. See what he did there?
2 things that should matter to investors most: return of your capital. In other words, I don't want my principal to be at risk, and the return on my capital. How much do I get for having taken that risk?
So he said return of capital and return on capital.
And people who focus on something like NAV erosion, as they're calling it, I think they need to sort of reset their expectations and understanding. And so
they fail to suspend the belief.
Yeah, I don't think that there's anything that I walked in and said, okay, here are the things we've got to change. It's not my place to do that, and I'm not well enough informed on some of the other things to even make that comment. But I can definitely see that some investor education is needed, and that's
so. In a nice way, he's kind of saying that some of their investors might be a little on the dumb side. That's what it sounds like to me. What are you all's thoughts? We'll ask him some blunt questions too when he comes on here.
The first thing I hope I can provide.
Jay won't get offended.
So if you read between the lines here, what I see, he's coming in to kind of see what else he can do, because he's known as like the options expert from what they're saying. So he's definitely going to be working on tackling this NAV erosion problem, I would say, if you read between the lines.
You can say something. Right?
I've taken a lot of lumps, Mike. I appreciate Ambassador's question. Always the intellectual question.
Why do you keep missing the best trades? There's a reason Wall Street traders spot setups before you do.
So here's another Jonathan Kwan question. What active fund did you actively manage, if any, and is it still active, and how successful?
I want the ticker symbol for this, so I'm going to watch this real quick, and then we'll look that up.
Was it for Mike?
So I've been involved with a couple different funds. So I used to work at, I'll start with my first buy side role. So a little bit of level setting for people who want to think about the way Wall Street is basically set up. We have sell side and we have buy side.
I can tell Jay uses Teams because every time I have him on, I can hear the Teams thing in the background. I use the same thing at work. And so it's like when you're using a platform for instant messaging in a work environment, you have like a sixth sense for it. You're like, it's like the message thing. It's like the sound, just you correlate it almost like with an alarm clock in the morning.
And then we sort of have this hybrid sort of proprietary trading role. So my first role was technically sell side because we were a dealer, but we were props. So we were essentially managing a limited partnerships pool of capital, and then essentially affecting a volatility arbitrage strategy with a market making operation, basically supporting all of the order flow that helped make that happen. So think about Citadel before there was a Citadel, what we were doing. So competed with.
For anybody that doesn't know, so arbitrage is basically implies markets are inefficient or not fully efficient, and that there's opportunity for extra gain in the market. That's what arbitrage essentially means.
Cooper Knapp and Susquehanna and people like that. And I went from there to a hedge fund called Ivory Capital. Ivory Capital was New York based originally, then Los
So he's a hedge fund guy.
Angeles. Ultimately managed about $5 billion, long, short, equity, options, and high yield, primarily with a deep dive.
I've never seen Jay so quiet. Jay's almost as quiet as when he's on, and he's almost as quiet as me when he's on, and I'm just mesmerized by his answers.
Fundamental approach. And then more recently, I ran a fund that was long only equity, but was using options analysis to establish what stocks we were buying into catalysts like earnings. That ran. That is now closed, but it ran.
That sounds really fascinating. By the way, the new thing I'm working on, and I'll do a video on this. I'm looking at stocks flying under the radar that basically they consistently beat earnings, but the street hasn't caught up to them yet. Because as I've been studying MCI extensively, which some of you don't think I do, some of you think I just buy stuff willy-nilly without even researching it. But as I've been looking at SMCI, I was researching what caused it to run up so massively in 2024. And if you look basically the 2 years before then, including that little recession that they didn't call a recession or didn't declare a recession that we had in 2022, SMCI was consistently beating earnings for like those 2 years leading up to that. So that's what I'm working on. I'm putting a spreadsheet together of stocks that do that, because that's a key indicator of something that's going to eventually, once the street realizes it, it's going to massively soar like SMCI did.
And in 23 and 24. And I think over that period, we outperformed the S&P, it was by a nominal amount, but maybe about 1% or so.
Yeah, but even Ulti's outperforming the S&P. That's easy. That's like a fool's errand at this point.
And we were only dealing with the top 250 names in the S&P, so that it kind of limits how much out or underperformance. I mean, some people probably looked at that and said, "You're a closet indexer." We weren't. We actually traded very actively, and we went into earnings. Anybody who saw FedEx when they really had that hard.
I just heard the words top and closet, but I heard top 250. I wonder if that means in terms of price appreciation, percent return, or what.
Horrible disappointment several years ago in the back half of the year. I had an outsized position in that, and that was not closet indexing. But yeah, so that was.
I like that. Did he just say closet index? I like that. Yeah, he used to be on MSNBC. Oh, well, that's the ultimate invalidator. Anybody that's on MSNBC. You mean CNBC, right? The business network. Because some of those networks are like propaganda on the political side.
The most recent one, and so we wrapped that up. The ETF business, I will say this, and this is one of the other reasons I have so much appreciation for the title team. I actually made this comment on a call earlier, is that had I teamed up with these guys sooner, I probably could have avoided a lot of the business and operational pitfalls of ETF operations early on. It's non-trivial. It's a heavily regulated space. It's expensive to have everything you need in place, and it's a business that benefits materially from scale.
I almost thought he was going to say he could have helped them avoid some of the NAV erosion pitfalls.
We didn't have the scale when I was running that actively managed ETF before, which meant that we essentially had to absorb all of that expense, all of that operation, all of that compliance, as well as do our day-to-day jobs of trying to pick and trade securities. This isn't a problem that YieldMax and Title have, because now they have the scale. I'm sure they had some real growing pains that I didn't get to witness. But
just a few. I'm sure.
I've been down that road, and not as.
Here's an idea. They should come out with a series of ETFs that are called Yield Min, that are lower dividend yields, but the like growth funds that the NAV basically appreciates more.
Successfully, so I can say with a certain amount of confidence that you must have it together to get this far in this business.
This quick, right?
Yeah, sure.
That's like in any business, I would think.
It's not easy.
So, Jay, there's a few questions on what Salty is. Again, back to Salty.
I mean, you had asked.
Salty, you mean slutty?
The question where my preference in the YieldMax product suite lies. And it's
going to skip a little bit.
Is in these more diversified products ultimately. But one thing, I mean, also I saw some messages about that too. Fix Misty, fix this. Don't speak to us. You gotta call Michael Saylor. The issue that you have there is not.
See what he did there? So he's saying it's the underlying. It's not us.
It's not a strategy issue, and these are strategies. If a stock goes down, stock goes down, and these are single stock strategies, so they're going.
Remember, the best strategy to fix NAV erosion, the best method to do it, the true secret, drum roll, is for the underlying to recover, right?
To track that. If a stock loses 50% of its value, a covered call strategy in that stock is also going to lose value. Maybe not quite as much. You collect a little bit of call premium.
That's funny. Oh, this Jim Cramer, because I was kind of doing inverse Cramer. In fact, there was funds that are like inverse Kramer, but he started getting his mojo back a little bit. He was a little more accurate. But I didn't know. He said, don't touch SMCI. That's interesting. Well, I did, and I've made money. Not everybody agrees that I've made money on SMCI because unfortunately, we live in a world where we don't always agree even on factual stuff. But I didn't do that because of Jim Cramer. I didn't even know that. That's an interesting tidbit of information there. Sure.
Yep. But its performance is going to be very close to that, right? So, when people look at these, it's funny because they tend, at least some of the feedback I've seen, is that people tend to have the same expectations from them that they have about a diversified fund, as well as the benefits of the individual stock. Well, you can't have both, right? It's going to be one or the other. These things are going to track the performance of the underlying stock. We want these stocks to at least trade sideways if they can, and hopefully they go higher. If they do, we benefit from being long Delta because we own the underlying, or we have a proxy for it, I should say.
I was long Delta when I had Delta Airlines stock,
synthetic stock, and you're looking to collect the decay. That's the game. And don't bother to open up your mouth.
Let's see. Okay, we're gonna look into margin maintenance real quick here.
Exactly. All right. So, question: any thought on the bias? Well, I guess you call it bias for broker.
So this is a good question. I don't consider this to be bias, and I listened to. I want to say I think it was Kumair's live stream the other day. Well, it was a clip somebody posted because he actually banned me, so I can't watch it, and I miss it. But a clip someone posted in Discord, he said he was mad at Charles Schwab again because his YieldMax dividends, he was mad at them because he said they changed their projection. Well, that's actually not their fault. I called and I asked why this happened because it happened to me too. That's them changing it because the dividends are so unpredictable. And I asked Jay blatantly, I'm like, Jay, what are your thoughts on this? Do you see this as disrespectful? He goes, no, not at all. Our dividends are unpredictable. Future Living says SMTX has amazing monthly premium waiting on weekly. Yeah, don't we know? Don't us options traders know for sure, right? All right.
This came up in the panel the other day, right?
So it's not bias. It's that the dividends are unpredictable. Even Jay agrees. All right, we got to end in like 5 minutes because I have another meeting.
Margin maintenance on YieldMax funds. Do you think there's bias at some brokers? I mean, I guess, do you have an opinion on margin maintenance?
How about just don't do margin? If you don't know what you're doing, don't do it. There's people on here like Todd and other YouTubers. They know what they're doing. But if you don't know what you're doing, don't even bother with margin. Use your own money.
Maintenance and how that whole thing works on certain funds. Do you think, I don't know if you're aware of the various margin maintenance that the brokers.
Yeah, I mean, we hear about it, right? Whether it's, with Schwab Hold It Out or Fidelity or IB or something.
That was a question that came up in the New York summit that we had. Can they work with brokers to get lower margin maintenance requirements? But it really has a lot to do with the unpredictability and the volatility of the funds.
The other places, right? I mean, it's one of those things that there's only so much we could do. They have their own compliance and risk department, so they're going to make their own assessment.
He just said it in a fancier way.
That's when it's funny you bring this up. I know actually today Scott called, actually was talking to Schwab about it, and some of the pushback on some of the ones they hold at 100% maintenance was limited history, crypto based, low average daily volume on some of them. It just seems like their normal MO is to be more cautious out of the gate, and we'll see that evolve over time. So
that's what the first time I asked Schwab when. They would only let me buy when I bought Coney. They would only let me buy it on cleared funds. They wouldn't even let me buy it on funds that had not fully cleared yet. And they told me, they said, we're a more conservative company. So because of that, the funds have to clear for a YieldMax product. So it's not disrespect. It's that it's a new product. So people have to realize that.
I think it's probably something that will eventually change. Certainly brokers that move first to make, maybe a more standard margin requirement are probably going to get more business. Like it's silly to me to think, wait, I'll let you buy Tesla, but then on Tesla, which has really lower volatility because of the call aspect to it, selling calls is going to be held up.
Yeah, it definitely has lower volatility because when Tesla recovered in November, Tesla didn't come anywhere near full recovery. So yeah, I'd call that lower volatility.
100%. Like that doesn't jive for me. So it's probably just going to take a little time for them to continue to do it. But it is something that we reached out to all of our past people, right? My life in the former Schwab Ameritrade world and our former E-Trade friends.
Yeah, that's right. So Jay worked for Ameritrade.
We talked to him, and it's a risk decision. Not too much to impress them.
So I would think that gives him some leverage over there. He's got contacts and stuff.
Something I would just throw in there. I think it's important to recognize that brokers are not a monolith. It's not just one person who's making both a determination about what makes the most business sense, what customers want, and what is risky.
You have to remember too, the broker, like if a lot of these investors that they're putting their whole life savings, their entire net worth in these products, and they're doing it on margin, that's kind of risky for the broker too, because then the broker would almost become a debt collector in a sense, right?
The risk department's something to say, and they should, by the way, about what people trade or can't trade.
All right, I have to address this because I'm emotionally triggered by this. So Rob Smith says, I am slowly getting out of YieldMax. How dare you? I got to ban you right now just for saying that, because this is a YieldMax cult. We love YieldMax. I'm kidding, of course. But why? Okay, Roundhill seems like the best funds. Oh, wow. Have more in dividends than NAV erosion, but hate selling with the NAV erosion. By the way, I will tell you this, not to plug YieldMax, but I'm studying, because I'm a big fan of the 0 date to expiration funds. I'm studying the YieldMax ones in comparison. I think some of the YieldMax 0 date to expiration are actually outperforming Roundhill, so keep an eye on that. Anyway, no, we won't ban you here for selling YieldMax. We don't do like that.
How they're going to conduct their business. Anybody who has run a risk book at any financial institution has had to contend with this. When we clear our business at Goldman Sachs, their risk department was all over us every day. It seemed like in 1999, 2000, and 2001. It seemed like there was not a day I wasn't talking to them. During the GFC, and this is going to seem incredibly ironic to a lot of folks, when things first started to roll over, I never heard from the risk department. In 2009 or thereabouts, I heard from them every day. We had hired, I think, 250 people into Cantor from Bear Stearns, including their entire risk department, which I found hugely ironic. It's
wow.
like, how is this possible that our risk department is now former Bear Stearns risk department? But those once burned, twice shy. These guys, I exchanged emails where a guy once said, you're over your risk limit in deltas in GLD. And I had 137 too many shares by his work. I had 5 million VAR on 5 million VAR, and I got an email about 137 shares of GLD. And I actually replied
they're selective
to him and CC'd the CEO of Cantor Fitzgerald. I said, just to be clear, you're asking me to sell 137
That was Howard Lutnick, I think, if I'm not mistaken.
shares of GLD. We're just going to put that on the record because it's so ridiculous. But you have to understand, risk guys, they have very little to win, with adoption of new things. But they have a lot to lose if it goes wrong. And just like investors need to be educated, portfolio managers need to be educated, traders need to be.
But somehow the same regulators never questioned Bernie Madoff for years.
To risk people. And it's not their fault. They've got a lot of things to look at. So I think this is new. I think a lot of them are going to have to figure out what's going on. And when they do, it's going to be fun. It just takes a little time.
Definitely.
Now we're going to get into protective puts, and then we're going to end it.
Okay. Shout out to ETF Inspector, by the way. He's another YouTuber. Great
question.
Jay. I don't know if you saw him. He covers Ulti. So, and you know how Ulti is. But the protective puts on Ulti, by the way, like SMCI earnings, awful, right? It went. But Scott and them, they did a great job, basically protecting. I know it's a small portion of Ulti. But speaking of protective puts, what other funds are you able to do protective puts on perspective-wise?
It's a good question. So LFGY, GPTY, so Chippy, what is that one? CHP.
And those are all weeklies, and they've all been more stable. So that's interesting. The protective puts seem to be working.
Right. Those kind of style funds, we can. So the baskets that aren't the target 12s can have puts on them. We've had puts in LFGY, by the way, on Bitcoin, on the Bitcoin index in the past. The market's closed, so I don't mind telling you this. You're going to see that we redid those puts in LFGY today, right? We rolled them up on that on the SIBO Bitcoin ETF index. So you'll see us.
Okay, so there we go. So that's the funds that can have protective puts. All right, that was the last question I wanted to go over there. Rob Smith says Tesla. Oh, I thought you said you're slowly getting out. That means you're still in. So you're probably holding the bag on Tesla like I am. Tesla still pays my house payment for the last 2 years, but God, the NAV, right? Roundhill doesn't have a cap for growth. I know, like, honestly, what you're looking at, what you see on your broker, it's worse than that. We'll go over that in another video, but basically after the reverse split, if you do the math on what you originally put into Tesla, it's like you lost some of that like out in the ether because of the way the reverse split worked. So believe it or not, your percentage down is actually worse. We'll cover that in another video. I have the entire spreadsheet. Here's a comment I like. I don't worry about NAV. Like I say, who gives a crap about NAV? As long as you get the income, right? YieldMax is for income. If I care, I buy VGT. Yeah, I mean, I personally care about my share value, but to each their own. Anyway, I'm going to sign off, everyone. Thank you all for tuning in. Like, comment, and subscribe. Join Discord, and please, when you join, because we're getting a lot of you that join, and I'm appreciative because we're getting a lot of coaching sessions, which we didn't even talk about options trades in this one, but the coaching sessions are really ramping up. I appreciate all of you all reaching out, and you all seem to be getting value, and you're coming through Discord, but I'd like it if you all could actually talk in the Discord. It's fun when more people talk. We've had a very active Discord before. I know we'll get back to it again. I have no doubt about that. So thank you all so much for tuning in, and we will see you all very soon. Take care. Have a great night. Bye.